Founders Floor, a co-working accelerator for startups.
I'm a software engineer turned entrepreneur, sold a company in the 90s to Oracle, went to NVIDIA when that was one of 47 failing graphics companies. Now, of course, they're doing great, and I take very little credit for that because I left there many years ago, but I am holding some of their stock right now. Yeah, I bought it pretty high, though, but it's all good. And yeah, and I've worked in venture capital a couple times in my life. In 2006-07, I was a partner at a small firm that was doing basically high-tech medical devices. That was our primary focus, and we would do some things around the periphery of there. And then got pulled back into the startup world and did another 3 startups where I was either a CEO or a founder or a senior exec. And now I'm at Ignition. I've been there now for about 2 years. Ignition is we're on Fund 6 right now, about a 20-year-old venture firm. Started life in Seattle and very focused, I would say, on the Seattle ecosystem. Some of my partners are ex-Microsoft people, like the former CFO of Microsoft, the guy who built Azure at Microsoft's one of my partners. And a lot of the companies that we've looked at are companies that big enterprises look at as things you fill in your IT stack of all the software. We were early investors in Splunk, for example. We're in Docker and Cloudera. DocuSign just went public last week. We were one of the oldest and most patient, I guess, investors in that company. And yeah, these days, I'd say we've moved a little bit away from what our bread and butter used to be around the infrastructure. We're kind of moving up the stack a little bit toward intelligent business applications. So things like if you had a CRM with some kind of machine learning in it, or computer vision applied to some kind of a healthcare application, those are the sorts of things that we look at most. And so they brought me and a few other people on board because my background with sort of math-heavy startups made sense for what they were doing. And now it seems every startup out there is trying to do something with machine learning or blockchain or cryptography. So it's so far been so good.
Yeah. We have a lot of questions to go through because he has a very interesting career of being multiple founder multiple times, working for a large corporation from small to big to being an angel investor to being a VC. But I also want to keep it collaborative too. So I want to take some questions from the audience. So during the talk here, think about some questions, and then at the end we're going to go and open up to some Q&A as well, so we can ask some of your specific questions. But talking about your career, for us here, we like to see technically led founding teams, and in doing so, sometimes those teams, they can speak the geek, but they don't necessarily have the gift of gab, and so. At the end of the day, these companies, they still need to be able to, effectively raise money, and they need to be able to, acquire talented people, and they need to be able to talk about their company, to potential customers, and on and on and on. How do you've done that, a really good transition from, starting out as an engineer and moving into kind of that business co-founder CEO role. Can you give some advice to some of the founders on
Yeah, sure. I personally always like teams where at least one of the founding team are deeply technical people, but both or all of the founders, you really have to be able to speak. It's much more important to speak about the application of what it is you're building, who the customer is and why they need this thing, much more than, I remember in my last startup, sorry, I'm going to go off on these tangents all night, but I had this block diagram that I made in PowerPoint. And for those of you who spend a lot of time in PowerPoint, you know that that's an awful tool. And I was so proud of myself. I had this big complicated thing with a bunch of arrows and little boxes showing all the different stack and all this garbage. And what I realized afterwards was nobody cared. Like all they care about is what's the input and what's the output. And I changed my slide at some point later to be a square, basically. I threw away all this junk that I had literally spent like 4 days trying to just get all the stupid, get all the things to align correctly and the font's too big and that thing wrapped and all that. And no one really cares. What they care about is like, what are you doing for me? Why do I want this thing? And how will it change my life? And if you can really empathize and put yourself in the context of your customer, your user, whoever that is, I think that makes all the difference in the world, whether you're technical or not. And for a lot of founders, you build this slide deck, you have 23 slides or whatever, 13, doesn't matter what the number is. You're so focused on, I got to get to slide 17. Like, let me just keep going through these things that you forget that the person sitting across the table from you, be it a customer or an investor, Like I kind of know your market, or I maybe don't know anything about your market, but if I don't know anything, I'll probably ask questions. And I think empathy is a really, really important skill for an entrepreneur. Actually, I maybe a year and a half ago, Stuart Butterfield, who's the founder of Flickr and now of Slack, was doing a talk at Stanford, and somebody asked him, what's the primary quality that you look for in Slack employees? And he said empathy, and I thought, what? That's probably the weirdest answer I've ever heard. I figured, you got to be like good in Ruby or Python or whatever nonsense, and no one really cares, right? Like ultimately, yeah, we'll find plenty of competent programmers. If you really understand how someone wants to use Slack, I'm going to go build features in a way that that person wants to use, and the stickiness of it will be great. And that's why, for example, WhatsApp was able to go and sell for $19 billion to Facebook, because all of the curves that they were able to show about customer acquisition, customer retention, daily use, all of these metrics that someone like Facebook cares about were off the charts. And they had a team of a dozen or 20 people, something in that range, who built something that people who were using it could not stop using it. I know I'm off a little bit on a tangent already. Like I said, that's what I do, and that's why the boiling down all this stuff to its essence was so awesome. But I think that is the most important thing to figure out, is how can you hide all the detail and just talk to the person sitting across from you in a way that they're going to care about.
Mm-hmm, mm-hmm. You touched upon this a little bit about fundraising, and I guess maybe we'll talk about that next. But before the conversation can even be had about when a company says to themselves, we want to start fundraising, and I really think they almost need to kind of look back and say, okay, what have we done in the past 3, 6 months to a year, and are we truly a fundable company? Have we thought about what we need to have in regards to metrics and stuff? And so, you've been an angel investor before, like I think Sandhill Angels,
Yep.
if I remember, and then
Yep.
VC now. What do you look for that and then the stages too? There's angel, there's C, there's Series A and beyond.
Yep, sure. So today I actually was sitting in jury duty, which is the most boring thing for those who've never done it. And we got a recess, and I went out and I was just trying to catch up on email. And one of the things I read, I'm going to plug, is not mine. There's a firm called Wing Ventures. It's wing.vc, I think. And they put out a blog post about exactly this topic. What is it that successful companies, what do they achieve? How much are they raising these days? All of those kinds of things. And it was very, very detailed. But I think it was written by Peter Wagner, and I don't remember exactly the title, but it was something about aircraft carriers and venture capital. And it was talking, the aircraft carriers are these giant venture firms who've raised lots of money. The reality is that companies are raising more in the thing that I used to call an angel round, now is called a seed round. An angel round used to be $300K, $500K. Now you're raising a seed round of $7 million, which is a lot of money. But the expectations have sort of grown along with that, and I would say probably the key thing when people are talking to an investor, that the investor wants to think about, okay, they need to understand what your thing is now, but I also need to envision, for the amount of money I'm going to give you, let's say I'm going to give you 18 months of runway to go build your company, plus some buffer because it never quite happens the way we want. But let's just say it's 18 months. What will this company look like 18 months from now? What will you have achieved? And telling that as a part of the story. Today we're at the point where we've got 6 customers who are piloting this thing, who are paying a small amount of money, but where we're at right now is we want to be able to raise enough that we can go from 6 to 20 or to 30 or to 60, whatever your number is, or to 6 million, because it's a consumer internet thing that you just need eyeballs on the site. And being able to talk about what those objectives are roughly at the end point when you go to raise more money, and sort of why the amount of money you're raising from me now helps you get to that point, makes a huge difference, I have found. Being able to say, I need 2 salespeople, but I also really need to go build these integrations with these 3 other systems, and I need engineering for probably like 3 months to go build. You've thought this through, and I can see that I'm investing now at a X $1 million valuation, and a year and a half from now, when you're out raising, it's going to be 2x or 3x or 1.8x or whatever the number might be. So I do think those things matter a lot. How much you're raising and who you're raising it from will certainly affect whether or not you have to already have revenue and paid customers and so forth. These days, a lot of companies who are coming into us trying to raise a Series A, which we think of as something in the range of maybe $3 to $8 million. That's about the size check we would write. They normally have a ballpark of either 10 customers or 10 pilots who are going to grow into bigger customers, or $1 million of recurring revenue, or some combination of those things as a proxy for there's probably some validation that this is not like you used to work for Bank X and you knew one specific thing that Bank X really, really needed, but they're the only customer that you'll ever have, right? If you have a couple of customers, that's usually a pretty good sign. If you have 6 banks or 2 banks, that's a pretty good sign you might be able to get to 30 or 50 down the road.
Yeah, and I'll add to that, because in the earlier stages, like when you're doing an angel or seed type round, I mean, traction means different for different stages. Traction on Series A, and obviously, revenue has to be that part of that conversation. But before that, in the angel and seed, it's really about just demonstrating you found a product market fit. Demonstrating that customers are using this, and even though they might not be paying a lot, they're expending some sort of utility out of that. They're garnering some utility out of that. And there's meaning in that for them. Especially if it's enterprise. I guess we're talking about enterprise more because Ignition's enterprise. Yeah. And so that's and the other thing is, investors, they don't know you, and so they're trying to figure out within a certain amount of time in this dating period whether or not they want to get married or not, and being able to kind of help them connect the dots earlier on by showing the process of how you iterated the product, or if you did pivot, why. Those are all things that are learnings that are helpful in the early stages. And I know you had to go through that also at Sandhill. I think when you were doing angel investments, it's kind of a different beast sometimes what you're looking at in regards to metrics.
Yeah, I mean, that's totally true. And one thing that helps a lot is try and get to know your investors before you're actually asking them for money. And sometimes that's hard because they feel like they have limited amounts of time and they don't want to just go out for coffee with every random person who asks them for coffee. But if you can craft a story around, you worked on these things in your past life, or maybe you invested in these companies a few years ago that have given you some perspective, and, we're kind of early, but I'd love to get to know you. And one of the things that you can offer to an investor that's really helpful is, I'm not looking to raise any money now, but if you don't mind, I'd love to just send you my investor updates every month for the next couple of months. I can start seeing you went from no product yet to now we have a prototype to now we have a first customer. That progress is a really, really good indicator that you can execute. And so I'd say the hungrier VCs, they're very open to taking a lot of those kinds of coffees and meetings and, trying to get on a bunch of those investor lists. And maybe I'm not an investor today, but I love to see these updates. And at some point when I feel like you're kind of getting to that turning point, I can come and approach you preemptively, because I don't want to have to go compete with a $4 billion fund. My fund is, a 20th the size of that. So, it definitely can work to your advantage. It is hard. VCs, the reality is they're getting pitched constantly, and some of them are very guarded with their time, and a lot of them they actually have a lot more free time than they'll lead you to believe, but they want to sort of make themselves appear to be very scarce. But the reality is you just have to work your charm, smile your best, do whatever it is you got to do to try and find a way to get some time with them. And obviously the other great thing you can do is figure out a little bit about them and who do I know who might know them indirectly, and don't just reach out to me because I'm part of some X billion-dollar fund. Reach out to me because you worked on this thing that's pretty interesting and might have a direct relevance for me, because VCs generally are pattern matchers, and we need to be able to go and compare against things we've looked at in the past.
Yeah. Wanted to continue on with this and talk more about post-funding expectations. So, I think there's a lot of misconceptions there with founders where, after you raise your funding, that's almost like a means to an end. In other words, they raise their money and then, yay, everything's roses after that. And I think that's just a misconception. The reality is, it just gets even more stressful after that, And you've done this before with your companies. You've raised millions of dollars. You've also invested millions of dollars over your time. What are some things you can say to founders about what they need to think about after they raise that round of funding?
Yeah, of course. So I remember also thinking the same, that you raise your first time and then you can celebrate. And I remember a much older person at the time said to me, "This is not the beginning of the end. This is the end of the beginning." Now all the work is actually in front of you to actually go do all the crap that you promised to somebody. And forgive me if I say words like that, but I'm from New York, forgive. So anyhow, I was also in the New Yorker?
New York.
Nice. Yankees or Mets? I hate baseball, yeah. Good, I'm with you. All right, so baseball is boring. But anyway, yeah, let's, look, I think it feels great, especially when you've been going out of pocket for a long time, bootstrapping a thing for a bunch of years. I remember, there was a point in time at my last startup where my wife said, are we really sure we want to write another check to the company? I said, yeah, it's all going to be fine. Don't worry, it's all going to be fine. And I went in my room and I don't have a lot of hair to pull out, but I was kind of like, man, I better not screw this up because there's a lot riding on these things. So it does feel good to raise the money, but honestly, raising the money is really just step one toward now I can go do all the stuff that I was thinking I need to go do, hire these people or go spend some money on some experimental ads or whatever it might be. I was a CEO for a Sequoia company when the poop hit the fan in 2008, and there was this famous event, now it's old, but 10 years ago, but they called all the CEOs of Sequoia companies into this room and they did this thing called RIP Good Times, Rest in Peace Good Times. And they had a slide deck that actually made it out onto the web and was like this huge deal at the time, where they were basically telling us the entire world might go through a financial collapse right now. It's that serious, stop screwing around. And one of the things I remember they told was, there was this CEO sitting next to me, and they never actually mentioned his name, but they were staring right at him and they said, we're tired of some of you guys just buying damn pool tables. Get your asses to work and go figure out how to make money. And by the way, so that guy was Reid Hoffman from LinkedIn. But they had just bought a bunch of pool tables with Sequoia's money, and they were pissed. And it worked out fine for him and for LinkedIn, and Sequoia. Everything always works out fine for Sequoia. But anyway, that was, it was, you just have to be smart with the money. And if a piece of what you need to do is reward your team in some way, take them out for drinks, buy them shirts, get a pool table, whatever the thing might be, so be it. But that's really where all the hard stuff begins. The one thing I would say that I have learned over time, though, sort of in contrast to that, is one of the most important things that founders can do at a company very, very early is establish your culture of what this company is about and who are the people and why do these people want to come work for me. And if that culture is work, 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 that's fine. And if that culture is we got nice pool tables, that's also fine. But I think just be really mindful of that, because more than almost anything else, when you have the job title of founder, it is your obligation in that company forever. Even if I was the CEO and now I'm going to hire a more competent person and I'll go be a chief whatever officer, it's always the case that you own the culture of that company for as long as you work there. So I would say invest heavily in thinking about that and making sure that that's a piece of what you do.
Yeah. You talked a little bit about this, how to handle diversity, but also rapid growth for that matter. So you've been with a couple companies through that rapid growth. One of them, NVIDIA. I mean, you came on board when they were 35 people,
yeah.
Hardly any revenue, to 7-8 years later, thousands of employees, billions of revenue. Probably to the outside, everything looked great and up and to the right, but the reality was probably it was very, at times, chaotic during that time internally. And, I think a lot of the companies, we all, in the crowd here, aspire to be that type of company. We want to be that $1 billion company, but it's hard. So you have any kind of stories or tips on how to handle that rapid growth like that?
Yeah, so Jensen Wong is the CEO of NVIDIA, and he's the founder. And when I first got there, one of the first idioms I heard from him that he used for the entire 8 years I was there, because it was true, by the way, was that we are always 30 days from going out of business. And my first week I was there, they kind of give you like here's your boss and here's your cube and whatever, office at the time. And then they have a company meeting every Friday, and they bring in beer and pizza and whatever, and Jensen pulls out this piece of paper from his pocket, and he reads us this number that's like $1,373,200 whatever dollars. That was how much cash they had left. And I was looking around, and there were about 50 people at the time. And like $1 million doesn't last long when you got to pay 50 people and a building, and you're taping out chips and all. And I was pretty damn nervous, and he puts that away in his pocket. And then he pulls out from his other pocket the first purchase order that they ever got from any customer, and it was like a purchase order for 30,000 graphics chips from some company who was going to sell them all to Dell and Compaq. And the whole place like erupted, in cheers and all that. But he reminded everybody, we really are 30 days from going out of business. Like, don't screw it up. Don't sit on your rear end doing nothing. And that's just kind of Jensen's, his way. And again, I think define your culture. And they always draw these charts of like, you're here today and you want to be there in a few years, and you sort of picture this line. And the reality is, it's really this incredibly meandering path. Company like DocuSign, which just went public, and it probably, I think now has about a $4.5 to $5 billion valuation. That thing almost got shut down about 5 or 6 times during its time. NVIDIA, which is a $150 billion company now, we really were on the brink of extinction at least 6 times that I was aware of. We're like legitimate, I was in the room where we were like, we don't know what to do to go fix this problem. We got sued by Intel, we got sued by Silicon Graphics, we were out of cash, we had late on product. I mean, many, many things that go sideways. And how you kind of deal with that and figure that out. Splunk was a great example. Splunk seems like this great success that they sell now. It's a $9 billion, $10 billion company. Their business model of getting end users to just get, I individually as an IT guy will go and use this thing. That wasn't by design. It was because they tried knocking on all the doors of CIOs, and the CIO said, we don't want to talk to you. Like, we don't care about this thing. And they got lucky, frankly, but when they had a bit of luck, the smart thing they were able to do was figure out, like, is that a repeatable thing? Did we do something here that we can do more of to try and enhance that? You got to just, whatever opportunities you get, you got to sort of maximize them. But it's every startup. My first startup, same deal. Like, we went into it thinking we were basically going to build an internet operating system to go power all these televisions and set-top boxes and junk. Today, people would just call it Android. And I was not the founder of Android, but the company that I was a founder of built something like that 20-something years ago. And we also got damn near to the brink of extinction, had big cable companies who take years and years to go figure out how to make this stuff work. And out of the blue, we basically got some opportunities. We managed to turn them into something good and sold the company for a very healthy amount to Oracle. It's a hard road, but when good things happen, you got to just figure out, is this an idiosyncratic thing, or is this something that we can repeat at least one more time? So
you talked about culture there, and I think that's really telling, building culture early, because with that rapid growth, one of the things you end up losing control of sometimes is just the fact that you just don't have the time anymore to hire everybody directly yourself, and then it starts to become an extension. Now you're given hiring responsibilities to other people, and how do you maintain culture so that when you go from 50 to 100 to now 1,000 or more, you can't possibly hire all those individuals yourself and say this is somebody that I agree is the right culture for it. How do you maintain that culture throughout that growth?
Yeah, I mean so by the way, when you get to that point, you're not listening or remembering some guy who was sitting here, right? You're at a 1,000-person company, but it does matter, and I think you just have to really genuinely live that. And so, for example, at my last startup, we had a Scotch bar. That was one of our things, and we did lunch and dinner for everybody every day. And you didn't have to stay for dinner. You didn't have to come for lunch. But if you were there, we had lunch and dinner every day, even when we were super small, and it felt to me like a lot of money that I was spending. And what I realized was, you and I are just sitting at our desks writing code, when we can take a little break, and I, the CEO, can just sit down with one of the engineers, and I can say, man, I just got off the phone with like JP Morgan or whatever, and they were bitching about this, and I could fix that. That's no problem. And 6 minutes later, it would be done. And if we went through the proper channel to go do all that stuff, it would have taken way too long. So I just think like it's so important that you have to invest your time in that. And Jensen actually at NVIDIA, when I left there, the company was 4,000 people. Regularly, all the senior vice presidents would sit together, or the senior muckety-mucks in whatever group, and Jensen would go just sit with the most random group of people who he didn't know every time. And hey, I'm Jensen, who are you? And he just wanted to hear from the trenches, like what's going on. Some engineer saying, oh, my tools aren't working right for taping out some chip. He'd go the next day to the or the next hour, 2 minutes later probably, he'd go to the SVP of hardware and say, like, what the hell, man, get these guys better tools. He came to me 1,000 times. I remember actually he sat with one of my interns once, and he came to me afterwards and he said, you apparently need more orange soda, I don't remember which one it was, Fanta or whatever, in your cooler on your floor. Like, he sat with a bunch of my interns, and one of my interns, the only complaint that he had was that there was no orange soda, which is ridiculous, but the next week there was like orange soda everywhere, and my intern came over and he was psyched. And he went back to school, he was at University of Waterloo, and all these Waterloo students started applying. It's like, that place is great, like they totally listened. No, not because we had free orange soda, but because this guy listened to, a nobody, basically, who is a super brilliant kid, but he really listened, and I think that stuff it makes a gigantic difference, more than your big brain trying to figure out the better business model, or your big technical brain, coming out with a slightly better algorithm. So.
You talked earlier about diversity, and I want to talk about how to handle diversity. And so, building a company is really a marathon, not a sprint. And you mentioned, I think, maybe in an email exchange we had, one of the angel investments you did 12 years ago, that company finally became that kind of big company now. It just takes a long time to build a valuable company. And, during that long time period, a lot of stuff can happen, a lot of crap can happen. You can use big clients, you can, get your, top, employees poached by, Facebook, Google, whoever. You can have a, economic meltdown, like in 2008, for example. What's some advice that you can give to, how to persevere through that, and, how to get through those hard times?
So, one thing I think that matters a lot is find yourself a co-founder, always. Maybe even two. I think once you get more than about three, it's a little tough, but 2 or 3, there was this great piece that Elon Musk wrote way before he was like the Elon Musk that all of us care about, when he was like an early, he was one of the guys at a company that became PayPal, basically. And he talked about this idea of standing at the edge of the abyss, just looking out at the darkness that was before him, and how valuable it was to have people with him along for that journey. And I remember when I was running my company in like 2010, reading this piece and being so thankful that I had this co-founder who I super trusted. We had worked together at NVIDIA for a long time. Because when things went weird or badly, which most of the time they go badly, very rarely things go well, but when they go well, sometimes they can go really, really well, and it makes up for all the bad stuff. But most of the time, the truth is, it's not like you come home at the end of the day saying, well, that was great, I made 1% growth for the company, and 1% and 1%. It's usually like, ugh, things are going horrible, 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 bam. Some giant customer, Exxon, signs up as a customer, or your article or your product shows up on the front page of the TechCrunch or whatever, and all of a sudden you get 1 million users to the site. I think having co-founders with you to be through those dark times makes a gigantic difference. And sometimes I think it matters also that, you may not be in the right position. You may be the right founding CEO to get this thing to some point. And at some point you might realize, what I really care about is like the product. I want to be the product person, and I want someone else to go deal with like hiring people and dealing with my board and all that junk. You still are always a founder. No one can ever take away that job title. And there's a lot of great founders who have figured out that they don't want to be that CEO. And, in the end, it makes them a much happier, much stronger contributor within that company. So,
I'll add to that in the fact that, being there's a lot of highs and lows like you're talking about, and I think it's important just to make sure that, when things are going really good, don't get super duper excited. And when things are going really bad, don't just, feel really super down in the dumps about it. And so it's important to celebrate the wins, no matter how small they are. Also, we have this thing we do here at Fundraising called Celebrating Wins every Friday during happy hour. And it's just like, whatever happened, even if it's super small or whatever, just celebrate it, because I tell you, there's going to be bad times like there always is, and it kind of helps you kind of get through it all. So I want to switch gears a little bit and talk about liquidity events for companies. Okay, so when a company gets a certain size, it's typically maybe an IPO is what you aspire to do, or maybe a M&A, where your company's purchased, and
yep.
You were through a couple IPOs with NVIDIA, and then I think Liberate Technologies, I think, was one of them you did?
Well, so I was at a company that we sold to Oracle. They spun it out, and it then IPO'd as Liberate, which was this gigantic .com disaster, but by that point I was out.
And then Ion Grid, that was purchased by
M&A,
NetApp.
right?
Right.
I had one I sold to Microsoft, one sold to Telefonica, one IPO that basically went bankrupt. So
How do you know, that's a big deal to start. How do you, as a founding team, how do you start thinking about, selling your company?
Yep.
I mean, you go from, there's a lot of things that happen. I mean, you all of a sudden, when you think about it, you're not the boss anymore if someone buys it, and.
Yep.
And,
yeah, so that was so there's a couple of things. First of all, a great thing I learned once from a friend of mine who works in investment banking was the best companies are never sold, they're bought. Meaning that you're not there trying to peddle your company on me. I'm there as the big guy saying, I need your thing to fit into my technology stack or into my product roadmap or whatever it might be. That's how you get a much, much better outcome for you. And so part of the way you have to do that is just execute. Part of it is just every partnership, again, try and tell that story in a way where your partner can understand how you can be accretive to their business, in part because it motivates them to want to partner with you, and in part because sometimes there's a corporate dev person sitting in the corner thinking like, hey, we could buy that. Like we have budget to go buy that thing. So past all that, how you come up with a valuation, I think, is ridiculous and almost impossible. There's no formula for it. There was a company called Nicira that sold for $1 billion to VMware. It was 40 employees, and they had negligible revenue. They had zero product revenue. They had a little bit of consulting revenue. And then there's other companies that work their tails off and get up to 300-400 people, and they end up selling for $30 million 12 years later. And sometimes it's a lot less than that. And by the way, 30 million, as a founder, you think, well, that's actually still sounds pretty good. The reality is, though, as you've taken on more and more rounds of venture investing, they build this thing called the preference stack, that if you don't know about that, you'll learn about that. But basically, preferred shares get to go sell all their stuff before you get anything. And there's a lot of companies where there was one of them that I was involved with where it ended up selling for what was effectively 26 cents on the dollar to the preferred investors. And that means 0 cents on the dollar for common shareholders, like the executives and the founders and all that. So, those things happen. I would say that the way I would think about if you have an opportunity to go sell your company, so my co-founder and I, we were very, very clear with ourselves that when we sell this, it is no longer ours, and we will be the best stewards that we can for the success of the product. But we knew there were going to be things outside of our control that that could make or break the success of this thing. So when you sell it, you got to be really clear, like, I'm selling it and I'm here to go do something for you to help transition it. But after that, I'm ready to kind of be out. So that's one thing. I think the second thing is if I come to you and say, I want to buy your company for $10 million, and you think, well, it should be worth 40. The way I would think about it would be if I don't sell this for $10 million right now, where I might make, for example, $3 million, and my co-founder makes 3, and the investors maybe make the remaining 4. If I don't sell it, how much work do I need to do with fundraising? And then what happens every time you raise funds is that the value that you have in the company goes down, right? Because now there's all these new investors who own a bigger chunk. How much more work do I have to do to get myself back up to that point where I can make back whatever that was? And with us in our last company, we were in the term sheet negotiation for our Series A when NetApp offered to acquire our company. They started out asking about investing in that round, and then it turned into, could we take the whole round, and then they bought the whole company. And we did very well. It was a very good outcome. But what we realized was if we didn't do this, it was probably going to be a good 4 or 5 years of just killing ourselves just to get back to where we were. And it was a good amount, and we said, you know what, this is the right thing to do, and we sold it at that time. And then promptly after that, the entire marketplace for the thing we were building more or less collapsed. So our timing was like incredibly perfect, and I looked like a genius, even though I had no clue that any of that was coming, and I was just tired from running a company. So it's very, very hard. What I would say is you can always, if you want to help yourself, the best things you can do is try and look for reasonable, comparable companies. Don't say, well, some guy named Nick told me that there's this thing called Nicira that sold for $1 billion or WhatsApp sold for 19. If you're not like WhatsApp, you're not going to sell for what they sell for. But if you can find a couple of examples Sometimes you can find some leaked information about how much they sell for. That can be very helpful. And then the one other thing I'll say, if you get the opportunity, is generally once you get a company to around maybe $15, $20 million in value, there are smaller investment banks that would be very happy to work with you. The basic recipe that they have is, even the smallest ones, they have a formula where I want to earn at least, for example, $500,000 to work on potentially helping you sell your company. And so if I have an offer for 10, and I think this investment banker can get it to 11, and they want $500,000, it's worth it, right? Now there's an extra $500,000 to go to me and my partners and investors. So I would say just sort of shop around, try and find a good investment bank. You're not going to bring in Goldman Sachs for $10 million, but there are specialized boutique investment banks that can help out with those kinds of transactions they can easily make a difference of another couple $1 million and pay for themselves.
On that same note, over the past, 5, 8 years, there's been a tremendous amount of early stage investors, angel and seed, that have flooded startups with cash, help them get started. On top of that fact is that it just takes less money to start up a company, especially a software company. So is there any kind of chunk here of startups where they're not making enough traction yet to be able to raise that Series A? And if so, do you see something where M&A is going to be a lot more active around this realm of pre-A?
Yes. In later stage terms, I think about, for example, the computer security market. There are about roughly 1,800 venture-financed security companies who are doing either security of your network or security of laptops, or they're looking for weird behaviors that might be a sign of malware inside, trying to attack your databases or whatever, or protecting your cloud. 1,800 of them. That's way too many. What's going to happen in a space like that is many will perish and some will get acquired, and then a few will remain as the bigger companies who can then continue to grow. If you sort of go to much earlier stages where you guys likely are, there is always a very unpleasant pinch that comes as you go from each stage to the next. So there might be, for example, 1,000 companies who go raise seed money. Of those 1,000, maybe only 40% of them or 50% of them will ever go raise an A. And of those who raise an A, maybe only 60% will ever raise a B, and then only 30% will raise a C. And those numbers change based on what market you're in. But it's important to just be aware that there's a lot of other people who are doing different things than you who are also vying for those same dollars from the investors. And if you're not seeing an obvious sign that if you had some plans or ambitions about what your company was supposed to do, and you're just way far behind, maybe it's just because your engineer it's his fault or her fault and they just couldn't get the stuff done on time. But maybe you didn't really set realistic goals, and you're going to struggle to go raise it the next round.
Yeah. I'm going to ask one more question, and then I'm going to open it up for questions from the audience. So get your questions ready here. But I wanted to switch gears and talk about, you have a pretty technical history and career, and one of the companies that you worked at prior in the venture space was with SRI International, and taking technology from their R&D group there and kind of spinning it out and productizing it. What are some of the differences in those types of companies, where you're taking what I call hard tech and taking them out and taking individuals that maybe a more academic type focus or research focus, and then now you need to think entrepreneurial, and you need to build a company. And how does that differ from, I'm not saying normal startups, but startups that maybe are SaaS
startups.
companies? Yeah,
we'll call them normal startups. So SRI, for those who don't know, it used to be part of Stanford University. It's this place that they literally invented the internet there. They have a plaque on the wall. They invented the first robot, which is now at the Computer History Museum. They were the original internet registrar. Siri came out of there, a bunch of crazy stuff. And the Stanford dish is actually not owned by Stanford University. It's owned by the Navy, but it's operated by SRI, not by Stanford. So there's this really weird science research lab, and there's a bunch of them around the country that are like that. And exactly as Matt said, there's a lot of people in those places who are basically like professors. And if you remember back to your college years, there was always that one super weird, nerdy professor who always had like a lab coat and like a duck under his arm or something. Those are the kind of people who work in these kinds of research labs. And And oftentimes they don't really know, I invented this cool thing, but I don't really know where it would be used in the real world. And so part of your job as an entrepreneur there is to not only help convince the world that this technology is cool, but also help convince those people who developed it, I got you. I got a pretty good idea here of what we're going to do. Siri came out of some AI research done in like 2004, 5, 6, and the purpose of it was to actually be an assistant to an admiral in the Navy. And what they figured out was when the smartphones came out with like all touchscreen, they realized that if you go to like for example, a movie booking website, all the buttons are like super small on that thing, and my big fat fingers, I can't hit the buttons. And they realized, hey, why don't we use some of that natural language stuff we had done to be able to say, I want to go see Avengers in Palo Alto at 7 o'clock on Thursday for 2 people. And we could go click all those little goofy buttons so you don't have to constantly be zooming in and scroll. So there was a big insight there. The natural language people thought, well, this is ridiculous. Like, how many people really need to go, like, I did all this amazing AI stuff, and you just want to go buy movie tickets with it. And Siri turned out to be a pretty cool thing. I mean, and it's got its problems, but it, as a spin out of technology from a research lab, it was pretty cool. I would just think back of if you ever have an opportunity to go work with a genuine, genius professor in whatever field it might be from your university or a place like one of these, there's definitely pluses and minuses. This is a lab that is 70 years old. They move at a fairly slow pace. Same is true at most universities. And, and as an entrepreneur, you just want to kind of bang through your stuff quickly. And, you got to figure out, at least while you're in that process of getting the stuff from them, how to move at their pace. And it could be quite an exercise in patience. I did it I worked at SRI for a year. And for me, ultimately, what I found was I talked too fast and I walked too fast. And I was going a little bit batty, trying to sort of explain everything in that kind of way. But it can be really awesome. I mean, because the technology in some of those places is genuinely, the stuff that 10 years from now people will look back and say, holy cow, you worked on one of those?
Yeah, my younger brother's actually a neuroscientist, and so he does research and there's parallels actually between startup world and the research world, where they, in the research world, they vie for funding dollars from government institutions, and they have to pitch it, and they get funding, and then they have to have some results after a couple of years, and so there's some parallels. But yeah, we have, startups now and prior here at Founders Floor that came from the research world, from the academia world, and it is challenging, At the end of the day, time is money, and so many times the way that they can move and think is different, because they're thinking more, from the research lab point of view. And
yeah, the one thing I'll say is that think of it as like grad students doing a lot of the work. It might appear to work well enough to get the paper written, but when you actually sort of peel it back a little bit, like it's held together with Scotch tape and bubble gum in many cases. And so just be aware, if you find a really cool piece of technology where some grad students are saying, we invented this thing and we think it could really make your stuff great, just figure out, like, is it ever going to scale in a way, or will I have to kind of rebuild it all from scratch? Yeah. But beyond that, it can be a lot of fun to sort of be at that cutting edge.
Yeah. I might open up to some questions from the audience here, and I'll pass the mic around. I'll go and spread it around here.
So you talked about the vagaries of figuring out valuation. I would imagine that's especially tough with pre-seed when they're trying to raise their first round. Do you have any rules of thumb or things that help you at least get it into the right ballpark?
Yeah, I mean, for our firm, a Series A, in general, we're going to buy about 20%. And it doesn't matter if you're looking to raise $3 million or $8 million, we're going to buy about 20%. So you can sort of infer the valuation based upon that. And so if you come to me saying, I need $8 million, I'm going to buy 20%. That means that the post will be 40, right? And so the pre will be about 32. And so my assessment of your company would be, is this a company that's worth $32 million to me right now? Because you're asking for 8. If you exact same company come to me and say, I need $3 million, and I can see that path for how that 3 gets you to the next round, now instead I'm talking about, it's a $15 million post, so it's a $12 million pre. It's a very, very different set of criteria that I would apply. Excuse me. Now, it may not be that seed investors and pre-seed investors and angels and everyone else uses the exact same thinking, but to me, that's kind of how I think about it, is that for many of the investors, they have some target in mind of how much ownership they want to have. And that's especially true, I think, with institutional, with sort of professional investors versus angels. And then the other thing, again, that I would, it's a good question to ask them is, what do you guys normally think about as a fairly normal range? Because if they're thinking their normal range is a $3 million post, and you're thinking you should be like 8 or 10, that's a good discussion to sort of clear early on in the conversation before you spend weeks going through all kinds of random due diligence, if there is such a thing, and and investing a lot of your time in theirs in something that's not going to lead to a happy outcome.
Raising money is hard no matter what, and sometimes you just have to go and just raise where you can get it sometimes, and sometimes that means doing convertible notes, and sometimes it can get kind of messy where you have different convertible notes at different caps and and discounts. And how does seed/Series A VC like Ignition look at those types of companies where you've got a lot of those convertible notes that are converting at different times?
Yeah. So one thing, by the way, and I should have mentioned it for the last question, was ask your lawyer. Lawyers, because they go through hundreds of these documents, like they're going to say, look, man, the truth is, I'll tell you in confidence, attorney-client privilege, like you're full of it. You're never going to be worth that for this kind of stage. And from an investor's point of view, with regards to the existing sort of obligations to investors, in general, these days, a lot of people are using safes. We would never invest in one that doesn't have a cap. We would never write it. We would never write a check into a safe that doesn't have a cap. As the investor on the other side, going in that follow-on round, I don't really care because I'm going to set the valuation. But the way I want to think about it is, all of these people who have gotten you to where you are right now, it's wonderful that they've done that. They're not going to add much value going forward unless you got Mark Benioff or someone like that as a personal investor, and now you got this special sort of accelerated path to talk to Salesforce. So the truth is, I don't mean to sound sort of harsh about it, but I don't really care about all your earlier investors. Like I'm not going to go and screw them over just so I can make an extra couple %. But there's plenty of people in the Valley who that's exactly what they will think. If we unwind all the obligations that you have to them, you did this note that you thought it was going to be $200K, and now it turned out to be $1 million, and they end up owning 67% of the company or something. What happens is I'm going to say there's no way I'm going to invest in a company where your investors own 80% of the company by the time you're at a Series A, for example. And so then my question is, do I want to go and invest, because I really love your idea, do I want to go invest the energy and time in helping clean that up? Which what that means is I got to go have a bunch of lousy conversations with your investors and say, hey, you own 13%, now I want you to own 2%. How does that sound? And so most investors will walk away, and you do that with everybody uniformly by restructuring basically the ownerships. Most investors are going to say at the early stages, like, life's too short, I'm just going to move on to the next thing. Or, hey, you know what, why don't you go fix all that and then come back to me once you've done that. And you can go to your investors and say, look, I got a choice. Either you collectively go from owning 60% to 20%, or I have to shut down the company. And what do you guys think? And they're going to say, we think you're a crappy CEO, but they may go with it. So I would say that those are really lousy conversations to have. And with one of my startups, that was exactly what happened. We had a note that we thought was going to be about $1 million, and we kept extending it. It was fine to extend it, but it ended up being about $2.5 million. And the key thing that we struggled with was I didn't put some basic language in there to say, in the event that I sell the company before I convert all of this debt into equity, what is the valuation? Or what is a cap on the valuation? And had I done that, life would have been great, but this was kind of before the rise of safe notes. And so, it was very expensive for me and my co-founder when we sold the company. But again, a lot of the investors were our friends and family and, neighbors and people. So it worked out okay.
Question up here?
Yeah, thank you so much. So I have two parts question. One is with respect to raising a capital, right? So initial part of the talk.
Sorry, with what?
With respect to raising a capital for a startup, right? So initial part of the talk, you just talked about, hey, you're looking at some of the cool companies who are actually coming in the area of like artificial intelligence and all of that, right?
Yeah.
So from Ignition Partners perspective, right? So what are those startups that you're looking at that actually would entice you to put your money, right?
Yeah.
That's part one. And second part of the question is, once the company has got the money and you've seen the plan, you like them, what kind of support you give as a company to make sure that they are successful?
Yeah, great
right?
questions. So again, we tend to go at Series A. The support you'd get from a seed investor would be quite different, but I'll speak at least on the context from my point of view. Sorry, I actually already forgot the first part of your question. Oh yeah. So we invest in, as I said, boring enterprise software, but boring enterprise software tends to make money if it's good software, so that's what we like. I would say something like, for example, if you had a CRM tool or like one of these mass email tools like Constant Contact and all that instead of sending it out to 23,000 people every time, it could figure out, here's the 38 people for this email, and here's the 1,000 for this next email. To me, that's an intelligent use of machine learning applied toward a very boring space that happens to be really big. Lots of people send out those emails and they pay Constant Contact and MailChimp and all those guys, tons of money to do all that stuff. To me, anything like that where you're taking an existing business that I can understand and you're disrupting it with kind of next-gen technology, I think is great. Because I can figure out, is this next-gen technology actually going to make a difference? So broadly, I'd say for Ignition, that's where our appetite is primarily. But sometimes we get crazy. Like I have one entrepreneur that's meeting with me who came out of one of the big government intelligence agencies, and they are doing this thing that, I knew the term, but I didn't really understand how hard it is, called homomorphic encryption. And I had to go to like Wikipedia, and then I had to go read a bunch of crypto stuff to kind of get it. But the idea is very, very cutting edge cryptography where not only is the data encrypted, but my query that I make against the data is encrypted and the results are encrypted. And the cool thing about that is, picture if I took all my data and shoved it in Amazon, I can go do those kinds of workloads in Amazon without any fear that Amazon will ever read my data. So very, very cutting edge stuff like that there's no established market for it, but it's kind of cutting edge enough and it's in this boring enough space of managing big data that we would have an appetite for that. As far as support post-investment, so the seed investors in the companies I've worked with, they do a lot of help with helping with basic staffing. Look, you need to get a salesperson. I got a stable of 10 or 15 of them who I can call. And Series A investors, you should expect that they would do the same. They can help you with things like getting yourself up and running with basic marketing and PR, those kinds of things. We do a lot of stuff, very specialized business development. So if we have one of our companies is doing some weird networking stuff, we will actually fly with them to New York and set them up for meetings with like 8 big banks. And one of the guys who goes to the meeting used to be an IT guy at one of the big banks buying networking stuff. And so he goes to these meetings, and afterwards they'll say, man, that was a great meeting. And he'll say, yeah, they're not going to buy anything. You didn't ask these 2 questions, and I can tell from who it was who came in the room that these are not the people with spending authority. And so there's those kinds of things that various firms can do. Most of the firms, they'll say that they'll help you with staffing. They'll help you with business development broadly and marketing. And then they'll help you with introductions when you're ready to do the next round.
Good. Question up front.
Thank you. My question is about ICOs. And where do you see the VC landscape? Like, for example, if I do an ICO for like 4 million, can I do a Series A or Series B? Or where do you see this in the next 2-3 years?
Yeah, it really depends. Very good question. So we just had a lawyer. He was the original lawyer who built the Bitcoin Foundation, I think it is, or whatever that thing is that manages Bitcoin. He built that thing for Satoshi. And so he knows a lot about Bitcoin. And he basically guided us, you should never invest in any company that is raising an ICO unless some very, very, very specific things fall into play. And the main reason why is because you're going to go raise all this money. I'm not going to participate in it. Are you still really motivated to go build a real company around this? But there are some businesses, like Filecoin is one, for example, where the token is a necessary thing in order to get the marketplace going for their product. And what they raised from VCs was not tokens. What they raised was capital for equity. And they have some agreements in place, apparently, that none of the founders and none of the principals or anyone can make money off of the coins that were offered. They're just using that to get their marketplace going for the product they're doing, which is some storage thing. So I would say My 2 cents is that ICOs and venture financing are relatively incompatible right now, and that may or may not change down the road.
Question back here.
Hi there. Do you have any tips for dating co-founders, if unlike in your situation where you had one from your prior role?
Yeah, so it's a great question. It's very hard to meet them. I get a lot of business people ask me, where can I meet a technical co-founder? And then I got a lot of technical people who ask me, there is really no great answer there. But, clearly some things that you can do would be, talk early about ownership of what it would look like down the road, and talk about ways that you can kind of build this incremental trust with one another. Why don't we work together for the next 2 months, and I'll give you X amount of equity in my company, for that 2 months of work. And if we love each other at that point, we can really talk about this kind of relationship where maybe we go 50-50 or maybe it's 60-40 or whatever. But have those conversations up front with some ratcheting up of the commitment. Like I'm married 20 years, and my wife and I, when we first started dating, we never talked about like, well, we're going to have to do these things before we can get to an engagement, and these things before we're married. But in a business environment, you should have a lot of the emotion removed from it, and it should really be a very rational discussion. Like, what are your goals? Here's some of my goals. And if I could make $2 million on this thing, I'd be thrilled. Is really different than, man, I'm going to go for broke. I want to be a billionaire. And if one of you wants one and the other one wants something different, that's a really hard problem to resolve unless you have a imbalanced ownership in the company where you still have total control to make that choice. So it's very, very hard, I would say. And I know plenty of people who it hasn't worked out and they just terminate their relationships with their founder. And then if you don't already have all that stuff talked through before you get start working together, it can get very, very messy. You stole my IP and I'm gonna go after you. And again, VCs just don't wanna hear about all that junk. And it just like, look, life's too short. I'm just gonna go to some next thing that doesn't have that legacy, so.
And always have vesting schedules, yeah, for sure.
Yeah,
for founders.
yeah, very true. Always vest.
Question over here.
Actually, 2 questions for you. For those of us who might be fortunate enough to get CVC investment, how would you recommend we structure it so we don't taint the water for future VC to follow?
Yeah. So my opinion about it is in the early days, corporate venture can be very dangerous unless they truly are totally passive. And the reason is because, for example, if you're in the insurance space and Allstate says they want to put some money in, it's going to be really hard to get State Farm or Progressive or all the other insurers to become customers because Allstate's going to benefit now from me spending money with you. But if you manage somehow to coordinate it early on that Allstate and State Farm and Progressive are all investors, then actually what's interesting is a lot of the other insurance companies will say, well, look, it's not like any one firm is benefiting from this, and screw it, we're going to go in and we can help make this thing be a industry-wide standard. But in the very early stages, I personally have found it's very tough to bring in corporate VC unless they're totally passive. It just depends on the firm. Like Intel Capital is not nearly as passive as some of the other firms that have a small, like NVIDIA's ventures is very, very passive, and no one would look at it and say, you're tainted because you took money from NVIDIA, because they basically do nothing with the investment other than wait for you to grow.
Okay. And the second part of the question was, when you're looking to target a VC based on their background, they're investing in that space, they're comfortable in that space. They also have investments in startups that potentially could seem a little bit like a competitor. How much is the entrepreneur really at risk of loss of IP by going to the VC who's got a portfolio of similar operating companies?
Yeah, I mean, it's with established firms, that's a great question. With established firms and established investors, their reputation matters if they're in this for the long term. I did have a feeling that one of the prospective investors in my last startup was trying to filter the information off to one of my competitors, and it turned out they were. And that competitor called me up at some point and said, hey, we should buy you guys. And that was a pretty crappy feeling. But the reputation does matter, and most VCs who are in this for the medium to long term are not going to, like the amount I might make, sort of taking advantage of you will be more than offset by the losses I'll have of a crappy reputation where, future entrepreneurs don't want to come talk to me.
Another thing to add about the CVC also was the fact is that, remember, those CVCs are being funded by corporations, and for them, they typically need to acquire technology to be able to continue their growth pattern. And so they're always constantly thinking about a buy versus build decision for themselves. And so that's different from a VC. A VC has a different scenario where they don't try to have overlapping companies in their portfolio. But with a CVC, it's about, at the end of the day, are we going to build this internally, or do we take some seeds and put them in these companies and then make that decision whether it's a buy versus build later on, And so you hope that there's this membrane and nothing passes through from the venture arm to the corporation, but you just don't know sometimes.
One really critical thing, actually, if you are going to take corporate money, which may or may not be a bad thing, there's a lot of corporate investment groups will hold an incubator type thing, and you could join those. Just make sure you're very aware of whether or not they have what's called a ROFR or a ROFN. So it's a right of first refusal and a right of first negotiation. Those are generally things where I put money in, and now if someone decides they want to buy you, I have the right to go and first negotiate with you to try and acquire your company, or I can refuse basically on that offer. You just don't want stuff like that, because VCs will look as, the first question they'll ask is, do you have a ROFR? And if it's a totally clean, no, look, they came in on a safe and there's a cap and a discount or whatever, but they're just like every other investor. That's a much, much easier thing for a VC to absorb than anything where they have any special terms.
We have time for one more question in the back.
Yeah. So we see a number of companies growing through ecosystems, developer ecosystems like NVIDIA, for example, right? Do you keep that as a factor in the companies that you invest in, or the companies that you have the portfolio right now?
Meaning, do I like to invest in platform type companies?
That's right.
Yeah, generally I don't. My view is that you build a product first, and if you have enough use of the product, maybe eventually it becomes a platform. But people who try and build platforms, generally it means that you're depending on other people to really go create a lot of value out of the thing you built, and those are things I would personally shy away from.